Welcome to Iron Financial. We're here to help you forge a stronger portfolio and cut right through all the market noise. And today, we've got M&T Bank in the hot seat. They just dropped a Q1 earnings report that, on the surface, looks absolutely bulletproof. I mean, we're talking beats on revenue, beats on earnings, aggressive stock buybacks. It's the textbook definition of a financial fortress. But then you look at the stock chart, and nothing. The stock just went nowhere. The market, for whatever reason, just isn't buying it. And that, right there, is our mission today. Are we looking at a fortress built to last, a solid addition to your portfolio, or is the market right to see a high-price trap? We're going to break it all down.
So here's how we're going to do this. I'm going to start by laying out the bull case. We'll kick off with those big headline numbers, and then we're going to drill down into the fundamentals, really build this fortress brick by brick so you can see why people are so optimistic. Then my skeptical friend here is going to step in. And once I've built this beautiful fortress, he's going to take a metaphorical sledgehammer to it. We're going to look at valuation. We're going to look at what the insiders are doing, what the big money is telling us. We will search for every single crack in that armor. And after all that, we'll come together and deliver the final iron verdict. Let's get to work.
All right, let's start building this thing. Any solid investment thesis, any fortress, has to start with a strong outer wall. And for a company, that wall is the headline numbers. M&T's Q1 2026 report came out absolutely swinging. And these aren't just digits on a page. Think of these as the granite blocks of the outer wall. Let's dig in and see exactly what has the bulls feeling so confident right now.
First thing you have to look at is core profitability. Diluted earnings per share, or EPS. M&T posted $4.13. Now the Wall Street consensus, the estimate, was for $4 flat. In a market environment like this one, where companies get absolutely crucified for missing by even a single penny, a 13-cent beat, well, that's a massive signal of operational strength. It tells you management knows what they're doing. They are executing, plain and simple. The engine is firing on all cylinders.
Now look, one solid earnings beat can sometimes be a fluke, right? Or one-off event. That's why we always look for patterns. And a 24% year-over-year jump in earnings per share, that is a powerful pattern. That's not just incremental improvement, that's serious acceleration. It tells you that this big Q1 beat isn't some random event. It's part of a much larger positive trend. Management isn't just treading water here. They're actively and aggressively growing the bottom line. This is exactly what you want to see from a company you're investing in.
And you know, they didn't just do it with financial wizardry. They backed it up with top-line growth. Revenue hit $2.44 billion, which was another beat against the forecasts. Now that 5.2% growth, it isn't quite as explosive as that huge EPS number, I'll grant you that, but it's critical because it proves this profitability isn't just coming from cutting costs to the bone. This is real, sustainable business growth. So let's put it all together. A big earnings beat, massive year-over-year EPS growth, and solid revenue growth on top of it all. From the outside, these walls look impenetrable. Of course they look impenetrable on paper. Let's see what happens when we start looking under the hood.
You know, headlines are for amateurs. Any real investor knows that a true fortress is built on a deep and solid foundation. We have to see if these impressive numbers are actually supported by strong fundamentals underneath. So now we're going to go past the headlines and drill down into the core metrics that really matter for a bank. This is where we find out if M&T is truly a well-built structure or if it just has a nice fresh coat of paint. Let's go inspect the reinforcements.
First up, let's talk about the lifeblood of any bank, its net interest margin, or NIM as we call it. It's really simple. It's the spread between what a bank earns on its loans and what it has to pay out on its deposits. The wider that spread, the better. And in an interest rate environment where most banks are getting their margins squeezed really tight, you have to look at this chart. M&T is actually expanding its NIM. It's moving steadily up from 3.66% a year ago to 3.71% now. That slow, steady upward climb is a beautiful thing to see. It shows incredible discipline and pricing power. They are literally making more money on every single dollar they handle.
And this table here, this really drives home the point about consistency. This shows the 5-quarter trend, and it demonstrates that this isn't a one-quarter wonder. Now, yeah, if you look closely, you can see a slight dip in net income and some of the return metrics in the most recent quarter, Q1 2026, but that's coming off the incredible highs of 2025. You have to look at the bigger picture here. The numbers remain incredibly strong, they remain predictable. This management team clearly knows how to navigate a full market cycle, not just the good times, and consistently deliver high-quality earnings. This isn't luck, folks. This is just top-tier execution.
Let's be very clear about something. A bank is absolutely nothing without a strong loan book. Bad loans are like a weak, crumbling foundation that can bring the entire fortress crashing down. But when you look at M&T's books, their foundation looks like it's built on solid rock.
Their net charge-offs, that's loans they've had to give up on, are tiny, just 0.31%. And that number is actually falling year over year. Their non-accrual loans, the ones that are getting into trouble, are also declining. What's the big takeaway here? It's that they are not juicing their growth by handing out risky loans to just anyone. This is what disciplined underwriting looks like. Their credit quality is, in a word, pristine.
Okay, before we get to the final pillar of this fortress, I just want to quickly define a key term you're going to hear, the CET1 capital ratio. You can think of this as the ultimate stress test for a bank. It measures its highest quality capital against its risk-weighted assets. For regulators, this is the main indicator of a bank's ability to survive a major crisis. So a bigger number means a bigger safety cushion. It's quite literally the thickness of the fortress walls.
So what is M&T's CET1 ratio? 10.33%. That is way, way above the regulatory floor. And what's really incredible is that they maintain that massive capital buffer while at the same time buying back $1.25 billion in stock this quarter alone. Now just think about that for a second. They are growing earnings at a rapid clip, they're keeping their credit quality pristine, and they are returning massive amounts of capital to shareholders, all without weakening their balance sheet. That, to me, completes the bull case. From this perspective, this fortress looks absolutely unassailable. Unassailable, you say? Every fortress has a weakness, and that is exactly what we are going to go find right now.
Okay, that's a compelling story. I'll give you that. The internal numbers, they're beautiful. They're what every CEO dreams of printing. But we don't just sit here and admire the architecture at Iron Financial, we stress test it. We push on it until it breaks. So it's time to stop looking at the company's glossy press release and start looking at what the market, which is the only opinion that actually pays the bills, is telling us. Let's start searching for the cracks in this so-called perfect armor.
And right here, this is the question that blows a giant hole in the entire bull case. If the company is so strong, if the numbers are so good, why is the stock a total dud? Why did it go nowhere on this great news? There is a massive disconnect between the story that management is selling you and the price that the market is willing to pay. And that tells me that smart investors out there are seeing something that the bulls are either missing or choosing to ignore. We're about to find out exactly what that is.
So, first piece of evidence, valuation. Let's forget feelings and narratives. Let's look at some cold, hard data. Guru Focus runs a very sophisticated quantitative model to determine a stock's intrinsic fair value. It's based on its financial history, its growth prospects, all the hard numbers. And right now, their model is screaming a warning. This stock appears to be significantly overvalued.
Look at the raw numbers here. It's pretty stark. The model says that M&T, based on its fundamentals, is worth about $188 a share. But right now, it's trading at over $220. That's a 17.5% premium. The market is telling you, loud and clear, that the current stock price has gotten way out ahead of the underlying business fundamentals. This is the first major crack in the fortress. It's a classic valuation trap waiting to spring.
And now for what I think is the kill shot. Forget the models for a second. Let's just follow the money. And not just any money, the insider's money. The people who actually run the company every single day. So in the last 6 months, how many insider purchases have there been? The answer is 0. A big, fat goose egg. None. Not a single share bought by an insider. Now how about insider sales? 9 of them, for a grand total of $11.6 million. Let that sink in. The people who are supposedly building this fortress, the ones who know every secret, every strength, every weakness, are selling. Unanimously. If they truly believe their own story, that this company was a fantastic value, they'd be buying hand over fist. But they're not. They're cashing out. This isn't just a red flag, folks. This is a 5-alarm fire.
So that insider selling, that's a tremor coming from deep inside the company. But the skepticism isn't just isolated to the C-suite. Now we're going to broaden our view. We're going to look at the institutional smart money and at the stock's own bizarre trading history. We're about to expose some even deeper fault lines that you need to be aware of.
Let's follow the hedge funds, the so-called smart money. In the last quarter, 478 funds cut their positions in M&T Bank. Only 447 added to their positions. So the net flow of institutional money is negative. More of the big, sophisticated funds are reducing their exposure than are buying in. They are voting with their feet, and it looks like they are slowly walking away.
And here is the pattern that should frustrate any long-term holder of this stock. Just look at the reaction to the last 4 positive earnings reports.
3 separate times, the company came out, reported positive news, beat expectations, and 3 times the stock fell on that news. This is the definition of a sell the news stock. What it tells you is that the market has this deep-seated distrust, a fundamental caution that even great earnings reports can't seem to fix. It's a persistent warning sign that something is just not right with the market's perception of this company.
Okay, hold on. Let's not paint this as a total disaster. You're focusing only on the sellers, on the negative data points. The professional analyst community is not bearish on this stock. You have 4 buy ratings and importantly 0 sell ratings. The consensus is a moderate buy, and the median price target is up at $231. That's still comfortably above where the stock is trading today. They see modest upside from here. Modest upside and a huge pile of hold ratings? That's not exactly a roaring endorsement, is it? It sounds lukewarm at best.
So, here we are. This is the final showdown. We've meticulously built the fortress on a foundation of what look like stellar fundamentals, and we've found the fault lines based on some very concerning market signals. It is time now for the final stress test. Let's weigh all the evidence on both sides of the scale and deliver the iron verdict.
And here it is, laid out side by side. The fortress case, the bull case, is simple and it's powerful. It's based on undeniable internal strength. You've got powerful growth in earnings and revenue, you have widening profit margins in a tough environment, rock-solid credit quality, and huge share buybacks. It is, by all internal measures, a fundamentally sound operation. And the fault lines case, the bear case, is just as clear, but it's driven entirely by how the market is behaving. The stock looks overvalued, the insiders are selling with both hands, the smart money is trimming their positions, and the stock has a history of falling on good news. It is a classic battle between pristine company fundamentals and deeply, deeply suspect market signals.
And that ultimately leaves you with the final, crucial question for your own portfolio. Do you bet on the fortress? Do you trust the numbers, the execution, the fundamentals that the company is reporting? Or do you bet on the market? Do you trust the valuation models, the insider selling, the broad investor caution that we're seeing in the price action? Is this a durable structure that's truly built to weather any storm? Or are those tremors we're feeling a sign that the foundation is already cracked? That's the decision you have to make. Do your own homework. Thanks for joining us here at Iron Financial, where we help you forge a stronger portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.